Good, good. You know, I was wondering, I had to ask Reed, what does YPN stand for? He goes, young. Like, that includes me, right? Nah, maybe not. I don't know. But anyway, I'm really happy to be here today. And is this clear? No, I didn't think so. I don't know how to fix it. How about if I pull it away? Is that a little better? Yeah, okay, good. I still hear that weirdness. Well, thanks for having me. I don't know if you've noticed this or not, but my gosh, the exchange market is just going nuts. Investors are, everybody kept saying, well, it's going to go down, the interest rates are going to go up, people are going to back off, prices are going to back off. I'm sorry, well, if that's true, that's just not now, at least not yet. But I kind of don't anticipate it happening for a while because I don't really see any really dark clouds in the economy at this point. As long as people keep working and making money, I think that's a good thing. But let me tell you why these investors are moving. It's because this is what they're looking for. Number one, cash flow. Remember, these are rentals. These are investment properties. These are properties that they do their business in. They're not held for personal use. It's not held for, because of I like the floor plan or I like the color schemes. It's because of this. Cash flow. And cash flow is broken down into two areas. Number one, monthly income. And number two, rate of return. Look, we want the properties to work for us so we don't have to. I mean, isn't that why you and I buy investment property? So it'll do the heavy lifting as far as the income. And remember, think about it. You want to close it. You close one deal a month in real estate. You get paid once a month. You have one unit in real estate in terms of properties. You get paid a commission. That commission is called rent. If you want to get paid every week, you have 4 front doors that are paying you rent. If you want to get paid every day, you have 30 doors that pay you rent. And the other thing that's a beauty about real estate, guess which way rents are going to be going? You know this rent control thing? Do you know that's going to work against tenants? Because so many of these properties are not owned by big corporate management companies. You know who they're owned by? People like you and me. And guess what we do when we have a really good tenant? We tend not to raise the rent. And we do in smaller increments. Why? Because we want to keep them in there. Because they're treating the property right. That's going to change now with rent control. They're going to raise the rent more often. At least, once a year. So I think this is going to come back to bite them. But remember, cash flow, or better yet, rate of return, we can talk about a little bit more. But the bottom line is, that's the number one motivation. What's the second motivation for selling these properties that they already own? Appreciation, right? Look, if you have all your equity in one property, or you split it up into multiple properties, which one of those properties is going to go up as the market goes up in value? The answer is all of them, right? So the bottom line is, why would you put all your equity in one property? A lot of people say, but I feel more comfortable if I pay the property off. Well, that's good as far as your personal residence is concerned because you live there. It's not your money maker. It's your home, your shelter, your castle. An investor is looking for more ways to appreciate. And appreciation you can't control other than doing capital improvements to the property, but it's where the market takes it. Number 3, I need a tax write-off. Why? Because the more I make, the more they take. I'm not going to get political, but I will tell you this. If you are in a 24% tax bracket, you're in a 24% tax bracket until you what? Make more money. Then they go back and tax you based on the higher levels. So the reward for working and creating more properties and creating more cash flow and appreciation is what? Higher tax rates. And that's really concerning to investors, and that's why they love real property, because you can do what to it? You can depreciate it. You can write it off. For how long? 27 and a half years if it's what? A residential building. What if it's a commercial building? 39 years. So what happens if I have a 200-unit apartment building? Is it residential or commercial? The answer is it's residential. It's still 27 and a half years. And that's the beauty of depreciation. It reduces the amount of income taxes that I pay on the cash flow that the property is generating. Oops. That's right. All right. Cash flow. More importantly, rate of return. You're going to see that in a minute. Appreciation, tax write-offs. So how do I grow it? The answer is releveraging. What does that mean? Well, I don't live here in the South Bay. I live in Whittier. I live right next door to Rose Hill Cemetery. Very quiet neighbors, people dying to get in. Yeah, okay. But I'm above them all, though. No. I will stick to my day job. We have a lot of palms. In fact, we're going to Hawaii soon on vacation. We love that stuff. And one of the types of palms I have is called a sago palm. Everybody know what those sago palms are? You know what's really interesting about those palms? Like any palm, you give it water, it's amazing what happens to it. Well, over time, guess what the sago palm does? It makes little babies. They start growing off the base. So guess what the gardener and I do? We take the base, the little babies, and we replant, right? So now we have what? Multiple properties or multiple plants growing together at the same time. And that's what you do to releverage. I'll give you another example. You have two properties. Property A, property B. You own them both. They're on the same street. They're in the same city. They're the same floor plan. Same square footage. Nothing is different. Nothing except for one thing. Property A is paid for. Full equity. Property B, it's got debt on it. So let me ask some questions. We think which would actually cash flow better? The answer is, hey, the one that's paid off because I keep 100% of the rent. But which one gives me a higher rate of return, A or B? Why? Because I have less skin in the game, less equity invested, and I can still charge the same amount of rent because it's the same property. Does that make sense, rate of return? Because it gives me the equity to do what? Number two, which will appreciate faster? The one that's paid off or the one that's leveraged? You're going to go the same. Number three, which will give me a better depreciation, assuming that I bought them in the same year? The answer is it's going to be the same except for two things. Number one, and Stu said he was going to correct me, so that's good. If I told him I'd correct him too. So, number one, you know that $750,000 new mortgage money stuff that they passed in the Tax Relief Act a couple years ago? What's the limit on a new mortgage? In terms of what I can write off? $750,000, right? Right. But does it apply to your personal residence? Yes. Does it apply to your second home? Yes. Does it apply to your rentals? No. That it does what?
Apply to income property.
That it does apply? Yes. Well, then they need to have a little talk with me.
Yeah.
All right. Number two. How much is my property tax write-off? Maximum. What can I write off for property taxes now because of the Tax Relief Act? $10,000. That'll get you a lot here, right? That's only true of what property? Personal residence, second home, vacation home. What about my rentals? No limit. So ultimately, releveraging is going to help me take the equity I have to do what? Make it grow. To create other cash flow appreciation and tax write-offs and more properties. So the next question is, if I choose to sell it, How do they tax me? Based on the equity in the building? No. And Stu's going to spend some time with this. But very briefly, they're going to charge you a tax based on your capital gain. A lot of people think it's based on equity. It is not based on equity. It's based on the sales price, if you sold it for $1 million, from the adjusted basis. The basis is what I purchased the property for, and it'll go up and down based on capital improvements that I put into the property. Anytime I put capital improvements into the building, what does it do to my basis? It increases the basis. Is that also true for my personal residence? Yes, absolutely. That's why they want you to save your receipts on what? Your capital improvements. What are those? Upgraded roof. What else? New windows. Remodeling. Expansion. Adding on. On a rental property, depreciation is going to affect it on the downside. Closing costs are going to be factored in. So at the end of the day, regardless of how much equity, because if I refinance the property before I sell the property and sell it and there's no equity in the property, do I still pay a capital gains tax? Yes, because it has nothing to do with the amount of equity I have in the building. So the sales price minus the adjusted basis equals the capital gain. Now that's a very simplified version of that. Only people like Stu should be doing that, or attorneys who specialize in taxation. So how much does it cost? Up to 20% to the IRS, as high as. Number two, after $200,000 as an individual or $250,000 as a married couple, it goes as high as, it begins, let's try it again. Over $200,000 as an individual or $250,000 as a married couple filing a joint return, you pay the health care tax. You know, the Care for California and Obamacare and all that? That, number three. California, number one. I'm a Dodger fan. They have the Mookie Betts now, and they have brought out on David Price. We think the Dodgers could have another good year. We'll see. No comments. But the bottom line is that for sure, California is number one. We are the number one tax state in the union. Up to 13.3 to the state of California. Remember, these are as high as, right? Except for this. And this is recapture of depreciation on my rental. Remember, I got to depreciate it, to write it off? Well, the government wants 25% of that back when I sell the property. That's if I say, happy birthday, here's your gift. But when you get rid of it, you owe me 25% of it. That's essentially what happens. So the bottom line is, the government says if you have allowable depreciation, you have the option to depreciate it. If you choose not to exercise that option, you still pay the 25% tax, whether you take it or not, because it was allowable. So, what is the 1031 tax-free exchange? No, it's a deferred. What does deferred mean? Later. Kind of like the federal government, you know? Later. It's a real estate transaction. If you're able to take a listing and you're able to help that seller buy, you can help them do a 1031 exchange because it defers the capital gain. It doesn't forgive it. It's not like the 121 principal residence exclusion where you get up to $500,000 to a married couple of exclusion of your gain on a principal residence, or up to $250,000 to a married couple. So it would, to an individual, sorry. So it takes up to $500,000 exclusion. You don't get $500,000 back. You get excluded from taxes, $500,000. Does that make sense? And how often can I exercise that principal residence exclusion? One time, every 2 years. So every 2 years, unless I do a conversion. What's a conversion? I see McDonald's and the rest of them are already doing their Lent special or their filet-o-fish sandwich or whatever. So apparently it's in big demand now. But the bottom line is, you know what a real conversion is as far as the IRS is concerned? It's when I own more than one property. So whether it's a second home or vacation home or a rental, I choose to move into it. I convert it. And then after conversion, I live in there for, and then I sell. Do I get the 500? They changed the rules, but not 2 years ago. They changed it in 2009. And what they basically said was that if you choose to convert property you already own into your principal residence, live in there for 2 years, take your 250, 500 exclusion or up to, guess what Stu will do? He's going to have to go through a gyration of equations to determine qualified versus non-qualified use for each year going back to when this went into effect, 2009. And guess what you'll get? He'll figure out what the percentage is of the 250 or the 500 you get based on that equation. So just don't tell somebody because they're selling their principal residence that they automatically get $500,000 because you don't know. And you're not supposed to give what? Tax advice out. So have them talk to somebody like Stu. That make sense? So what's a deferred exchange? It's to defer the gain. Why? Why should I defer the gain? What am I doing? This is my new computer. Because I want to acquire better income producing properties that will grow. See, it isn't just about not paying taxes. It's more about more growth in the area of investment real estate that'll work for me so I don't have to. Make sense? What do people do when they sell a piece of property? They sell so they can do what? Buy up, buy bigger, better. And cash flow appreciation and tax write-offs is the motivation that's driving them. Now, how did that happen? Back again. That's so strange. All right. So what happened? Next question everybody asked me, so what happens? Like, don't I eventually pay the tax? Defer, 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 defer. So I start when I'm 28, and I'm a young professional. And then I go on and on and on and on, and now I'm 85. I know I look like it, but I am not. I'm 85 years old, and I decide to cash out. What's my tax based on? My adjusted basis beginning at the $300,000 to here. So the sales price minus the adjusted basis is going to be my capital gain, and guess what? I'm going to have to pay taxes going all the way back to the first one. So guess what I'm not going to do? I'm going to exchange, but I'm not going to cash out. Why? Because I need money when I get old too. That's right. So the bottom line is that I can keep exchanging and going to other properties that I don't have to manage as much. We'll talk more about that a little later. But when I die, if I have a trust, or if I have the properties in different LLCs, but the trust is the shareholder of the LLCs, guess what happens? When I die, and for me, it's not a big deal because I live next door to, Rose Hill. So better yet, not so bad for my wife. But what happens? The answer, I'd love to answer your question, but they told me I can't do that because this is being recorded and that they're going to give you a mic and then you can ask me. So I apologize because that's not how I normally operate. But no, thank you.
We'll have plenty of time for questions.
We'll have plenty of time for questions. So here's the deal. The thing is, when I die, they will get my basis, and then when I sell the property, they'll turn around and pay the tax? No. Not if I have it in a trust. There's other ways of doing it, but I like everybody should have a trust. Why do I create a trust? 3 reasons. Number 1, probate. Probate is too expensive. The attorneys love it. And it takes a long time. Number 2, I'm a control freak. I want who to have what at what time. Number 3, stepped up basis. So if it's worth $5 million when I originally bought it for 3, and now that I'm old and gray and I die, it's worth $5 million. It goes to my heirs at the basis of the fair market value at the date of my death. In fact, my wife will get a stepped-up basis. So she'll get the whole thing at 5 if she's still alive. Or the kids will get it. Does that make sense? You know what we call that in our industry? Swap till you drop. So which properties are eligible for this? Only 3. I got a call this morning from Santa Maria, big title company, big escrow division, and they want to move their properties around and stuff. And the question was, what really qualifies? There's only 3 properties, and here they are. Number 1, held for income. Held for income. Stu, do you have a problem if they have a kid in the property, paying them rent? See, that's the question. The real question is, really, are they paying at least close to fair market rent? Isn't it right? That's the problem. So if they're not, guess what it's considered? A second home. And guess what? Second homes are not exchangeable. Does that make sense? So it has to be held for income, cash flow. Number 2, you have your business in it. Mr. State Farm here, he brought lunch. Neil, there he is. Do you see? I've seen so many State Farm offices that converted like a residential home and put their office into that. You've seen that? Yeah. Well, I've seen it here in LA County. But here's the deal, is that it's a residential building, but I'm conducting my business out of it. Is it held for business use? The answer is yes. Therefore, I can do a 1031 exchange on it. Number 3, or is it held as vacant land for investment? Could I buy vacant land with the hope that it would be worth more in the future? The answer is yes. Guess what? That's exchangeable. These are the only 3 properties that qualify for the 1031 exchange. Does that make sense? Next, so if that is, what isn't? The answer is your principal residence, but we already know that you're eligible for the 121 principal residence exclusion if you own it and lived in it for at least the last 2 years or cumulatively 2 of the last 5 years, and you're on title. So Stu, see, you didn't think I was going to pick on you so much. All right. What if she owns the property as a single person, she meets her lover boy, they get married, but they need a bigger place later on, a couple years later. He's never on title. How much of an exclusion does she get? Did you hear that? She doesn't get 500. Yes, she is married, but he's not on. Because what are the requirements to get to the 121? On title for at least 2 years, ownership, and living in it cumulatively 2 of the last 5 or the last 2. Does it make sense? And that's what you have to do to get this 121. But you cannot do an exchange. What if my property's in PV or on the Strand and I bought it for 300, now it's worth 2 million? Can I take the 500 and exchange the rest? The answer is no, because it's your principal residence. But what if it's a upstairs that I rent out exclusively and I depreciate that on my tax return and I claim the income for Schedule E? Can I do both the 1031 exchange on the value of the rental portion and take the 121 on the portion that is my personal residence? Yes, the answer is I can do both because they're separate. That would be true if I had a 2-unit building and I lived in 1 unit. Same thing would happen. Or if I lived at a 4-plex, I take the 121 on the portion that I occupy, and then the remaining balance, we do a 1031 exchange on it. Does that make sense? Second home, vacation home, like my relatives in New York would say, forget about it. No, you just can't do that. Flipping, generally speaking, no. Why? Because it was never occupied by a tenant. It was never held. Well, sure it was. It took me 2 years to fix it up. That isn't what, it's not qualified use. Yeah, it has to be in service, according to the tax people. So it has to be rented. Now, the government says it has to be a like-kind property. So what does that mean in English? I'm selling a condo, but I want to exchange into a vacant lot in San Bernardino because I heard that they're putting up an Indian casino, and I didn't really think it's going to jack up the value of all these commercial lots right around there. Is that like kind? A residential income producing condo into a vacant commercial lot? Yes, it is. Because the definition of like kind is the sale of what? Into the purchase of? And we already know what investment property is, according to what is exchangeable. Where can I buy? What does that mean in English everywhere, anywhere? Can I buy in the U.S. Virgin Islands? Can I buy in Mexico? What if I can get property cheap because of this coronavirus in China? Can I buy there? Here, it has to be domestic to domestic. That means anywhere in the U.S. or foreign for foreign. But I can't mix the two together in the 1031 exchange. Okay, that's a good question. That's called the U.S. territory. What are other U.S. territories? Guam, Puerto Rico, U.S. Virgin Islands, Syria, North Korea, Iran. No, I'm just kidding about those last ones. Technically, you'll have to talk to Stu about that because most U.S. Virgin Islands are not allowable unless you've got a business there and you have to do a bunch of things to qualify to exchange into. And we have done those before where there hasn't been a problem that they've actually been allowed by their tax people to go into Guam, for example, a U.S. territory. But it's kind of a rare thing. How do you set up an exchange? Everybody get one of those little booklets? Really, there's language in here, but really you should be using your zip form. And you know what it's called? The seller's intent to exchange. The seller's intent to exchange is a really helpful form because you can put what in it in this market where there's not a lot of inventory? The answer is contingency language. And that's what you need because you have to find the replacement property. So you do need an accommodator to go with you to escrow. Give you an example of what that means. I was just telling somebody. No. We're the only company in the world that does this. I'm just kidding. Just kidding. Okay. So here's the deal. My daughter, my youngest baby, is getting married in June. So, I'm just going to start a GoFundMe page. I just, my wife and I are making all the decisions. I just say, whatever you want. Yes, dear. That's all I say. So what happens is, long story short, because it's at a place that only takes 200 guests, there's a limited amount of people who can get on the invite. So guess who we can't send people to? I can't invite people on the B list yet unless some of the A people can't make it. In other words, if you don't get an invitation, you can't come, even if you're on the B list. Well, that's the deal here. See, I have to hire an accommodator, you have to have language in your RPA, or escrow has to draw a amendment that invites the accommodator to escrow. And without that, the buyer has to agree to it. The buyer has to sign off on you're bringing an accommodator to escrow. If you don't do that, forget about it. We're not invited. We can't attend the escrow to set up the exchange. Does that make sense? That is so important. And I got to tell you, I get at least 1 or 2 calls a week with people who said, I've closed my escrow. I need to set up an exchange. I have to pay $175,000 in taxes. And the answer is? Who said that? You're right. Forget about it. I just can't do it. Well, I guess I could. It's called tax fraud. And I guess I could be my cellmate in prison. Okay, for the sake of the discussion, because we have a limited amount of time left, there's basically 5 ways of doing this, but I think I've got another class next month or the month after here where we're going to take a 2-hour class where we can get into a lot more of these. But the bottom line is most people do not do this, though simultaneous means you what? Concurrent, right? You close escrow simultaneously on your sale and your purchase on the same day. Do I need an accommodator for that? Yes. The only time you don't need an accommodator if two people are actually trading properties via deed. Other than that, even if you close simultaneously, you have to have an accommodator. This is what most people do. It's called a delayed exchange. A delayed exchange says I have a limited amount of time to close my purchase to get this tax-deferred basis to go to the acquisition. Number one, I have 180 days to close whatever I'm going to buy. And 180 days is not 6 months. It's less than, by 2.5 days, depending on if it's leap year or not. 180 days to close. And if the 180th day lands on a weekend or a holiday, can I get to the next business day to close? No. The answer is, forget about it. The government did not want you to have a delayed exchange. It took a court with Starker and all that for the government to give us this. They had to lose a lawsuit back in the 60s to do this. So you have 180 days to close, and if it lands on a weekend or a holiday, it's not the next business day. It's that day or before. Number two, only the first 45 days to do what? This is a big deal, folks. Identify means what? It isn't just knowing, but it's writing it down, signing it. Who does that? The taxpayers that are doing the exchange, and submitting it before the end of the 45th day to the qualified intermediary, the accommodator, straw person, whatever. They call us a lot of names. Some I can't repeat in front of the ladies, but the bottom line is, can I change that list after day 45? Yes, and we could all go to jail together. The answer is no. Well, why did they come up with that rule? Because they're angry, bitter people. They didn't have to do this, but they lost the lawsuit, and they were PO'd. So the bottom line is, this is it. But that's not enough time because there's not enough inventory. That's why you use that zip form. And you'll never find it unless you type in these words. Seller's intent to exchange. So you can at least get yourself at least a 30-day extension on the closing of your sale if you need to, because guess what, folks? They're not going to give you an extension on this 45 days. So at least I can get an extension on my closing and not begin that 45 days for another 30 days or whatever you want to put into that zip form. That make sense? You don't like it? Talk to Gov Hutchison. He invented this stuff. Under the 3 property rule, how many properties can I put on that list? Up to 3. Can I change the list? Yes. How many times? 150,000. As long as you do it before the end of the 45 days. You remember that old story about Henry Ford? You can have any color you want as long as it is black. Well, that's the same thing with the federal government. If it's not on the list at the end of the 45th day, it does not qualify as a replacement property in a 1031 exchange. Can I buy multiple properties and split it up? Yes. Absolutely. Reverse. Backwards. You know what this is? That's opportunity knocking. What happens if you walk out of a listing and the seller is extremely motivated, has to sell, needs a 30-day escrow, nice property, prices it incredibly low, and you want to take advantage of it? Can you? Yeah, but you need a 30-day escrow. You don't have time to prepare your listing, get it on the market, sell it, get into escrow, close it. You're going to lose that because opportunity only knocks for so long, and if you don't answer the door, guess what? It's gone and goes to somebody else. So that's the beauty of a reverse exchange. A reverse exchange doesn't say you open escrow first. They don't care when you open escrow on a sale or a purchase on any kind of exchange. What they care about is when you close. And it lets you close the purchase before you close the sale. Isn't that cool? So I get a lot of phone calls. Well, I closed escrow last week on a purchase, and I was told I can do a reverse exchange. And the answer is, forget about it. Where were you when I needed you? The answer is no. Why? Because the accommodator always has to be involved with escrow before anything closes escrow. And we have to set up a holding corporation. That's going to take title to the property you're selling, probably, unless you're going in all cash on the acquisition. And we have to hold it. So you've relinquished it. And then can close the purchase first. And the sale must close within. That's how a reverse exchange works. It costs a lot more. Sorry? The asterisk means this. You ready for that? I bet you're going to be sorry you asked this question. Okay. It basically means if we take title to the relinquished property, the one you're selling, the 180 days begins the day we take title to the property you're selling. But if you're going in all cash on the acquisition, then we will wait one extra day to take title to the new purchase. So we will hold the new purchase while you continue to hold the sale property, close the sale within the 180 days, and then we deed that property, your new property, over to you. That, because it starts 2 different days. So you get up to 180 when the purchase closes. But it could be 179 because we have to take title to the relinquished property. We're almost out of time here. This is really important. Number one, boy, I don't know about you, Stu, but I got to tell you what I get. I get a lot of questions. Well, I'm selling for $1 million, but I bought the property for $100,000. So really, I have $900,000 coming out of the property minus closing costs. The question is, how much do I need to buy my new property for? The answer is?
Same value or more.
That's true. Equal or greater. But have any of you gone to Subway? You ever get a sandwich? You ever notice how thin they slice everything? I mean, you can put the meat up to the light and see right through. If you want to slice your exchange as thin as Subway does their meats and cheeses and their tomatoes and everything else, number one, all the cash from the sale has to go into the acquisition. What does not need to go into the acquisition? Well, non-recurring closing costs. What's non-recurring mean? Okay. No, points are actually not non-recurring. They're actually recurring. Remember, we're talking about a sale at the beginning. Escrow, accommodator. How about your commissions? Transfer taxes, right? Could be city and county, right? Recording fees, my fees. All that can be deducted. So let's say...
Private transfer fees.
You mean like from an HOA?
No. Well, private transfer.
Well, let's talk about that when we go to the question times, because that's a very good question, and I've got an answer for that. And if I don't know the right answer, I'll make it up, and you will never know the difference. I'm just kidding. So the bottom line is only non-recurring closing costs can come out of the proceeds of the sale. So let's say it's $70,000. So $1 million sale minus $70,000 leaves me $930, right? But I have existing debt on the property that has to be what? Paid off. By who? The title company. That's why you have sub-escrow fees, because the title company won't insure the property unless they do the payoffs. So the total amount of debt that is paid off at the close of the sale is $400,000. So $930 left over after closing costs minus $400,000 of debt to be paid off leaves me $530, right? Right? Okay. So the $530 goes where at the close of escrow? It goes into, it's wired to the bank as per the accommodator's instructions. And the accommodator holds that money, but it all goes into the acquisition of what? The new replacement property or properties, right? Number two, what about the debt that was paid off, the $400,000? Most people don't realize that. They just say it's debt that's paid off. I just replaced the equity. No, you don't. You have to replace the debt. How many of you were around 10 years ago? Anybody remember those short sales? How about foreclosures? What did the bank give you? Which means you paid what? Taxes on the forgiven amount. That's what happens in a 1031 exchange. If you don't replace the debt, you will pay taxes on it. At what rate? All those capital gains that I showed you, you will pay at that. Unless you what? Reborrow on the acquisition of the replacement property. You have to reborrow debt. But if you don't want to, the government says here's one way of getting out of it other than paying taxes. Reborrow. That's reborrowing. Bring in new cash as a substitute to reborrowing. So if you have $400,000 in the bank, the government will allow you to put in $400,000 into your new purchase escrow, plus the money that's coming from the accommodator, all goes into the acquisition. What does not have to be replaced in a 1031 exchange? On the sale end, non-recurring closing costs. So technically, I have to buy for at least $930,000 or more if I sell for $1 million. Yeah, but that was my original down payment. Yes, it was, but that has to go into the acquisition. But that was my money. What about all the capital improvements I put into the property? What about all the repairs they put into the property? The answer is it belongs to your bases, not you. It has to all go into the acquisition or you will pay tax on any cash that you keep or any debt that you don't replace via another loan or new cash. Does that make sense? And that's what the government requires. What about the money you have to fix up to sell the property? Isn't that a cost to sell? No. Unless the buyer counters you and has a request, they have a contractual condition of sale that you fix blah, 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 or give them a credit. Now it becomes a non-recurring closing cost because the buyer requested and you said it was okay. It now becomes a contractual condition of sale as a non-recurring closing cost. Make sense? So really, if you think about it, you're almost better off not fixing the property. Let the buyer ask you for it, and now it's non-recurring to do so, whether it's a credit or doing the work. Make sense? Okay. Now, I probably went a little longer than I should have, so I apologize. Here's the big question. Now it's time for questions and answers, and I would love to hear you. Let's start with you because I put you off first. Go ahead. Why don't you say your name and then say the question.
My name is Francesco. I'm with West Shore Realty in Palos Verdes. My question is, if a property has been paid off, you must, right now it's worth $2 million, was paid $170. Can the owner refinance, take $1 million out, put it in the cash, and rebuy another property at the end of the sale for $2 million and $1 or $2 million, and just exchange the balance of the other $1 million for the 1031 exchange?
I'm confused.
You shouldn't be. Okay. The property is worth
$2 million.
The buyer refinances before he sells the property.
That's a bad thing.
Why?
You're not supposed to take out cash with the intent to sell.
Ah, okay. Well, I didn't know that.
What do you do now?
Well, now,
so that's why you're asking the question. It's a good question.
Yeah, because now the seller knows that I'll have to give him that advice and talk to you.
Yeah. Yeah, it's better not to do a pre-exchange refi. Stu, how much time do you want to wait till they sell the property after they refi? At least a year?
I like to show up on 2 tax returns.
Yes. But what if they've refinanced in November and then listed it in January? Those are 2 tax returns, but that's really close.
I think that's a little close.
Yeah. 1 year is safe for most tax people. So I would not refinance a property that you're going to sell or with the intent to sell and just do the exchange of cash and debt replacement, and you'll be fine.
That's a big saving.
Oh, yeah. You don't want to pay those taxes.
The guy would be in trouble.
Yeah. Yeah, absolutely. We had another question over here someplace, I thought. Okay, go ahead.
Hi, my name is Adriana with Palm Realty Boutique. My question is on the step basis value. If it's my primary residence and it's not on a trust and I die, does my kid inherit at a step-up value or no?
Well, it depends on the way title reads. It's always best if it's a trust. Trusts are so inexpensive today. And it's going to have to go into probate if it's not in a trust. But if it's not in a trust, there are different ways of having rights of survivorship and other ways to take title that will give either a half or a full stepped-up basis to the heirs. It's really a lot better to go with the trust.
Mm-hmm. Okay, thank you.
You're welcome. Yes, right. Next question.
Are private transfer fees considered non-recurring closing costs?
What do you mean by private transfer fees?
Private transfer fees, you know what private transfer fees are. In a homeowners association such as Playa Vista,
all right,
they have private transfer fees.
That is a cost of sale.
As opposed to a non-recurring.
Right. Because that's a requirement to sell the property for the buyer to get. It's a one-time non-recurring cost. But you can't pay for your backlogged association fees that you haven't been paying for, or your backed up property taxes you haven't been paying for as a lien, because those are all recurring costs that should have been paid back then, right?
Well, property taxes are a recurring cost, so you can't.
Yeah. So is insurance, right? Yeah. HOA fees, those kinds of things. But for something that requires, like I have to produce the CC&Rs and articles of incorporation and stuff like that, those are all one-time costs, because I'm producing them to do what? To sell the property. Point of sale. Very good. Yes. Yes.
Hi. On the delayed, what is the 200% rule, ID4 properties? Can you elaborate on that, please?
Yes. Did you notice when I had the 3-property rule, and then under that was the 200% rule, which I tried to skirt away from, but somebody had to ask me for it? Actually, no. I don't mention it because you really don't use it here. It's not for the people in the big city. The 200% rule is there to identify 4 or more properties. So if I need to buy a lot more than 3 properties, because I'm buying out of state, I'm buying ranch land, I'm buying, farmland, where I need a lot of ranch, where I need a lot more parcels, I have to have down 4 or more properties. So the government says on that identification where you have to go 4 or more, you identify each address or each APN or each legal description, whichever. And next to each identification, you have to identify the fair market value of that parcel. You have to total all the values together. The total value of all the identified properties, whether you acquire them or not, but the total identification of all the properties cannot exceed more than 2 times what you sell for. So if I sell for $2 million, I can't identify more than $4 million worth of property. I buy roughly $2 million or more, right? And that's cool. Government let me do that. But really, you can't do that in the 3-property rule because there's no restriction to value. So if I sold for $1 million, I could put down $100 million properties for my 3 properties. There's no restriction to value, just a restriction to 3 properties. And that's the difference between the 200 and versus the 3-property rule. Yes?
There you go, miss.
What happens if I sell my property in California, my rental, and I buy a property in North Carolina? Do I pay California tax?
All right. Are you living here?
Yeah, I'm living here.
Okay. And you want to exchange into North Carolina?
Right.
So this is how it works. California has a new reporting system that said, well, if we had a California flag here, which we don't, what animal, what's our mascot?
Bear.
The bear has a, California has a claw-back rule. That's the way it works, actually. I may have made some of that up. But they have a clawback rule, which means you have to report to the Franchise Tax Board every single year. What is it, an 8324 form or 8432 form? Something like that. I don't remember the name of the form. But they have to report it every year that you still have that property. And if you don't report it, they will claw back. Or if you cash out in North Carolina and not do another exchange, California will claw back their portion of the tax.
Are they going to charge me every year on my...
No. You just have to file that form and you'll be fine.
Now, let me ask you the other question. Now, I've decided to exchange into North Carolina, and I've already also decided to move to North Carolina.
All right, that's fine. But remember, the taxation is based on the state that the property resides in,
Yeah.
where it is. So if you live in North Carolina, that you'll pay the California tax, but it exceeds the North Carolina tax, so you probably won't have to pay anything to North Carolina because they're not going to double tax you. But if it was the other way around, you live in North Carolina and you own taxes in, wait, I got this right. You live in North Carolina and you own property in California, California always comes first because that's where the property is.
So basically, if I move to Las Vegas, I still have to pay tax in California on my California rentals.
Clawback. Yeah, unfortunately.
Okay, we got one over here.
Yes.
Yeah, my name is David Tai, and I have my client use your company service.
Thank you.
And they are very happy with your reasonable price and great service.
I paid them a lot of money to say that.
Anyway, my question is, if my client goes through the whole 1031 exchange process, and for some reason they fail to meet the deadline or they never did the exchange, what will happen to them?
They put them in the electric chair.
So is the government going to go after them?
No, yeah, what happens is it's going to report as a failed exchange. See, when you close a sale and you set it up as an exchange, escrow has to issue a 1099-S form. S means you're going to be, if you don't make this exchange. So basically what happens is that you have to make the 45-day identification. Right. If you can't find anything, your exchange is over. So if you think by the end of the 45th day you can't identify or can't buy what's already on the sheet, you should probably revoke it off so you can get your money back on day 46. Okay. Because the exchange is dead if you can't buy any of those properties. But if you don't revoke them and the properties stay on there and day 46 you want out, you can't have your money back until the exchange period is over in the 180th day. So that's why I want to encourage people, if they don't think they can acquire them, then just revoke it, end the exchange. You're going to pay the taxes. You don't lose anything. There's no penalty. You did the best you could. It just didn't work out.
Okay. But the government won't proactive after you.
Oh, no, because they're going to be looking at your tax return.
Right.
They will maybe in a few years if you don't pay the tax. But yeah. Yeah. All right.
Time for a couple more. There's one over in that corner.
Yes, sir.
You gave the example of kids or family members living in a parent's property and not paying market rent.
Yeah, that's a tough one. But yeah, go ahead.
If the owners or the parents want to sell that property and do a 1031 exchange, what were your recommendations on how they can
charge higher rent?
Charge market rent?
Yeah, I mean, really, it just comes down to if it has to be investment. If for it to be investment, if it's a related party, then you have to charge fair, 85% of fair market rent?
I always have the parents gift the rent to the kid, have them report the rental income on the Schedule E, and then they have a rental property.
There you go. Beautiful. Do it that way. That's going to come back to bite you in time, though, if you're into gifting at later times.
This lady right here is going to be our final question.
Yes, ma'am.
Hi, my name is Arlene Drew. I'm with Home Smart Realty in Torrance. My question is, okay, so my mother and father purchased a home in 72. They purchased it for $39,000. That home is now upwards of about $700, $800, and my father passed away in 2015. So now the capital gains, does that still qualify her to claim my father, even though he's deceased? With regards to the capital gains?
She got some kind of stepped-up basis, whether if it was in a trust.
Yeah.
Then hopefully she got a full stepped-up basis. Okay. And it's her principal residence?
Yes.
Yes. So remember, she's going to get up to $250,000 exclusion based on what? Based on the gain that starts a new basis for her at the date of his passing.
Okay.
All right?
Okay.
Okay.
Yes, thank you.
You're welcome. I hope this was helpful. I am so honored to be with you today. Thank you so much.
Give him a big round of applause.
Thank you. It's my pleasure. I'm happy to do it anytime.
Absolutely.
You want this back for him?
He's got his own.
Okay.
All right, so our next master is the master in CPA work, Stu Levy.
Thank you.
So I'm not real comfortable with the microphone. I coached soccer for 20 years, so I'm not used to having something else amplify my voice. So if I start to yell, don't worry.
It's my pleasure. You
I just brought, I didn't know, I guess I knew what Phil was going to talk about. There's a couple of things I want to just build on him. I'm not correcting him. But I bought some visual aids for myself. I don't have a video presentation. Every year accountants are required to, every 2 years accountants are required to take 80 hours of continuing education. This is an 8-hour course. What I do is I put the general knowledge stuff on the top, and I put the stuff that specifically affects my clients on the side. So there's a lot of crap in this book. And there's a lot of stuff in this book. Some of it's going to be important someday. One thing that I would like you to do for all of your clients when they buy a house is I'd like you to give them a folder. And in that folder, just two-sided folder. On one side, I want you to put their purchase document, that HUD 1 that says this is what I paid for it and this was all my closing costs. On the other side, I want you to tell them to put any improvements they make. I've re-roofed, I've landscaped, I've replumbed, I've remodeled my kitchen, whatever that is, I want that on that side. When they refi, I want them to build it on top of the original purchase escrow. All that stuff goes into basis. Several years ago, I had a client come into me. He sold his house. He bought the house originally sometime in the 60s. He told me that he tore it down and rebuilt it sometime in the 70s for about $100,000. Tore it down and rebuilt it sometime in the 80s for $150,000. Tore it down and rebuilt it sometime in the 2000s and sometime in the 90s for $250,000. And then he sold it. And we were trying to take his $250,000 homeowner's exclusion. And I think we did a fairly good job. Unfortunately, the government did not because I had no documents to prove it. So what we had him do was we had him photocopy every receipt he ever had related to that house. And we presented it to the IRS and we gave them a stack of paper this big. And we ran an adding machine tape on it and we told them this is how much these numbers come to. They accepted that number. It was a little bit more than we had reported, a little bit less than we had reported originally. He paid a little bit of tax, but if he had that book, life would have been so good for us. So please, that would be the most valuable gift you can give your clients. Because when they sell the house, or if they convert it to a rental property, or if they're buying a rental property, very important to have a good record of the basis. So that's all so the other thing, equity versus gain. So the question that I always get is, I'm selling the house, and I'm selling it for $1 million. And I have $1 million debt on it. So I don't have to pay taxes, right? It's not it. It's always basis. And so the difference between equity and gain, equity and taxability, equity and cash flow are very important to realize because people are going to say, I didn't get any money out of this, how do I have a taxable gain? You do. It's the hardest thing for me to tell people, it's the hardest thing for me to make people understand, but it is really very important that you understand that if you have equity, if you have no equity, but you have difference between basis and selling price, you have a gain. The debt doesn't matter. That's the answer I get. Well, I can't owe any tax on that because I'm not getting any cash. Yes, you have gain. So I don't know a better way to explain it to people, but if you have somebody who's selling the property and they're telling you that it's fully leveraged and they're not going to have any gain, please tell them that they're wrong, because I'd rather you get yelled at than me. And the other thing, and this is just a practice tip. Your question over there, you have $15,000 a year that you can gift, and your spouse has $15,000 a year that they can gift. And if your child is married, you can each give $15,000 to that person. So now that's become a $60,000 gift. And so if that's some way that you can convert a property in which your no-account child is living in to a rental property, that might be worth it. So you may have to pay tax because you're going to have to report that $60,000 of income, but at least you're gifting it and you're converting a second home into a rental property. And you should just do that right before you want to sell it. So, okay. Normally when I come up here, I spout a few things that I think might be interesting, and I just have you people ask me questions. Do you mind if I do that again?
Yes. The only thing that we ask is that you speak into the microphone, so that way your question gets recorded on our audio and video.
I thought you were telling me I wasn't speaking in the microphone. I was just going to throw this down because this is uncomfortable as all hell. So, perhaps you've heard something called AB5. AB5 is, I think the AB stands for abomination, because it's terrible. You know, I had a doctor call me yesterday. This doctor has a practice. The practice brings in someplace along $10 million. There are, I don't know, 8 doctors that work there. Everybody gets a 1099 because every doctor is employed by this corporation that is the medical corporation. And he called me up and said, I understand we can't give our doctors 1099s anymore. As a matter of fact, I was at a conference, and every doctor in that room said every CPA that they had told them that they have to be employees, they can't get 1099s. I told them no, because there was a contractual agreement between Company A and Company B, and Company B is paying Company A for their services. And you don't have to be an employee. I understand the logic of the rule was if you're making money for the people, and that's what the whole Uber and Lyft thing was. But if you're making money for the business, you are an employee. But if look, I'm nobody's employee. I do a lot of work for people. But they don't have to make me their employee because I provide them a service for which they've contracted me. So I don't think any of you have to become employees of your firms. So anyway, that's something. It's out there. So. Okay. And do you know, speaking of unions, do you know who's pushing AB5? The Teamsters, because they want to have more union members. So if there's any Teamsters in here, I'm sorry. Solar credits were 30% last year. They're 26% this year. They go down to 22% next year. Then in theory, they go away completely. I don't know that they will, but you should tell people just because you missed the boat last year, you can still do it this year. For you folks, meals and entertainment, and we've discussed this before. Entertainment is no longer a deductible expense. You can take me to a ball game, but you can't deduct that ticket. You can deduct my hot dog. So the beer is okay. So do you know why? And this is something that came up the other day and I found interesting to reminisce about, and many of you are young. So back in the 80s, maybe the 70s, it was discovered that executives were going to lunch and they were having 3 martinis. And it was referred to as the 3 martini lunch. The younger people here are laughing, the older people are shaking their head. They discovered the 3 martini lunch, and so the IRS's response was to say, you know what? Then you're only going to be able to deduct half of your meals. That's why we have that stupid rule regarding meals, because there were the 3 martini lunches. There's another thing, and I will put this in the back because you won't be able to see it up here, but there are 2 new forms issued by the IRS. The IRS last year, after 30 years, changed their forms. And this year, they revised it to look like this. Unless you're over 65, in which case it looks like this. It is literally a 1040 SR, and it is so older people who are presumably poorly visioned and don't have glasses will be able to see their tax return. I will leave these I just thought it was funny as hell, and all of my clients who get the tax return and says, what the hell is an SR? I have to explain to them it's because they're old. SR is for senior, yes. The other big news at the end of the year was the Secure Act. Did you all hear about the Secure Act? It is the Secure Act is an attempt to change the way retirement accounts work. So the way retirement accounts used to work is if I died and I left my retirement account to my kid then had over their lifetime to take my retirement account. Now they have 10 years. There are exceptions to that, spouses, disabled people, and I think there's a third exception, and I don't remember what it is. But generally speaking, if you inherit a retirement account, you've got to cash it out in 10 years. You don't have to cash it ratably over 10 years. And so it's actually a planning tool. If I die and 1 year in there, my kid's unemployed, that would be the year for them to take their portion of it because they just have to take it. It doesn't say when or how. So, and the other thing that I found very interesting, and this actually is in this book, they were discussing current legislation. AB, and you should look this up, don't take my word for it, AB 127 says DUI is not a crime if you're doing it for research. I got to tell you, I think that was brilliant. Okay, now it's your turn. What questions have I left unanswered or not even started?
Well, you talk about the, what's that, the, contractors rule. Is that labor department get involved in that? Because I have a client who has a massage parlor, and the labor department determined all the workers there is not contractor, and he has to pay the workers' comp,
employment tax, workers' comp.
Yeah, so this get penalties.
So there are a lot of people who have historically, and there any lawyers in here? They tend to be lawyers and doctors. They like to pay their employees as independent contractors so they don't have to give them benefits, they don't have to pay workers' comp, they don't have to pay the employment taxes. And more often than not, they're wrong. I don't have a problem with AB 5 classifying actual employees as employees. And so if you own a massage parlor, and I have to, there's a connotation to that I'm having trouble getting out of my mind. I have a client that is an exotic dance location, and all of their dancers are employees. That was the result of a class action suit about 5 years ago. So all the dancers, when you guys go, or you ladies, I don't want to, discriminate, when you go to a dance club, all those people are employees because of a class action suit 5 years ago. But if you are truly an employee, if I am telling you, you come here, you work with my tools, and you run the schedule I tell you to run, you're an employee. And you don't really get a shot around that. I don't have a problem with that. Usually what happens is one of those masseurs got fired or was told not to come back because you can't fire somebody who's not an employee, and they went down to the EDD and filed an unemployment claim, and the EDD went back and said, well, wait a minute, actually you really were an employee. And there were, back in the old days, the 20-step test. That was a much more fair test. So I think, so the answer is the Department of Labor does get involved. I don't think they might be involved with AB 5, but the specific example you gave, I think, is different.
Okay, so all these doctors, can they sue their employer for being a contractor, not an employee?
If they're going to say that they should have had benefits, I'm not a lawyer. I can't answer that question. And I don't like when people sue people.
How about the interest for HELOC? Is that still tax deductible?
If it went into the house. So if I bought a house for a $100,000 loan, and then I take a $100,000 HELOC and I add to the home, that interest is deductible.
Or for home improvement?
That adding to the home, make a home improvement. If I took that $100,000 and went to Tahiti, the interest on that is not deductible. And you're going to ask me, how do they know?
Yeah, how do they know?
They don't. And so you have to be, it requires a degree of honesty. And let's face it, income taxes are all, they're asking you to tell the truth. 5% of Schedule Cs get audited. Far less ordinary tax returns get audited. So they're really relying on us to tell the truth. And it's our job to ask you to please tell us the truth, so when you do get audited, we don't look bad. So, I hate to look bad too.
Thank you.
Nobody, it's February 25th. Nobody has a tax question? Phil has a question.
We're finding that there are more and more partners or people who have title as tenants in common are treating their tax return as a partnership as opposed to tenants in common. What happens now?
Well, if it's a general partnership, it doesn't matter, right? Because a general partnership doesn't need anything. Right. So if you're filing a 1065 and you're saying it's a partnership and there's no written document, that's okay.
But they're issuing K-1s.
K-1s are a function of the 1065.
Right.
If it's a general partnership, it doesn't matter.
It doesn't matter.
Doesn't matter. If it's an LLC or a limited partnership or any other kind of organization, there needs to be an agreement. But if it's just a general partnership, if three of us get together and decide we want to do anything that's legal, we can call it a partnership without having a document.
Right. But what happens when they decide to sell the property and go their own directions?
So that's the trick. And oh boy, that's a 1031 question.
Yes,
boy, I'm glad you're here. So
I got caught.
If a partnership owns a property, the partnership has to do the 1031 exchange. So now let's say the three of us, you, her, me, we own a property together, and we decide that we're going to sell that property because it's a loser. But you guys want to be done with real estate, and I want to buy another place. So at that point, we have to, in the year before we sell it, distribute the assets to the partners. And so if this house, we then say, we go through, we file, we quit claim the deed from the partnership name to each other and to each of us, and then you have a third interest, I have a third interest, you have a third interest, I have a third interest, and we can sell the property and we can each do what we want with it. So that's the only peculiarity. You have to break it out first. Follow up?
That's called a drop and swap. But there's also something called a swap and drop. And if the partners just want to exchange but don't want to be together anymore, didn't do the distribution of that asset, then the LLC, the partnership, can sell the property, do the exchange, and the partnership has to buy 3 properties, one for each one of these partners, and then sit on it for 12 months. And then do that, then dissolve after the year. And that's a big deal right now because you're seeing more and more LLCs and partnerships involved for what reason? Limited liability, especially in the LLC part, right? And the biggest problem you have is when one of those people or two of those people don't want to reinvest and one does. So they could always buy that partnership interest, acquire that, and then get rid of the two of them and then do the exchange because now they own the entity. So, but that's a big deal in your business right now, and it'll continue to grow.
Other than an annual fee for putting a rental property in LLC for protection, what other expenses are involved?
Well, you need to have a tax return, and that's always money. The $800 annual fee, and if the rents are going to be over $250,000, which if it's a single residence, probably not, the fee goes higher. Right, over $250,000, there's an additional $900 fee. I think at $300,000 or $350,000, it becomes $2,500. It starts to get out of hand. I had a client this year. They're an LLC, and their gross receipts were $1,001,000, and so they went up to the next level of LLC fee, which is not pretty. Okay. But there's also a $20 biennial filing fee with the Secretary of State. Right. If you don't do that with the Secretary of State, first that $20 becomes a $250 fine, and if you don't do that, it becomes a $400 fine, and you're suspended, and which is a bit of a pain in the neck.
So then, if you have multiple rental properties, you should have separate LLCs for each one?
Absolutely. Or, as a shout out to my friend in the back who's an insurance agent, a lot of people just say, rather than go through the cost of forming an LLC and maintaining the LLC, because there's also supposed to be annual minutes to an LLC, just like a corporation. And so rather than go through all that, the suggestion that has been made to me at all of my seminars has been to just buy more insurance. You want to make sure you're covered. Okay. And so if you were here before, and I think I make the story, if Jennifer Aniston is at your house and gets killed, you're going to be sued for a lot of money. If your insurance is high enough, you're okay. But and just so the way we've resolved that is we just don't invite Jennifer Aniston.
All right, my question is, what happens if your seller is a foreigner?
That's a good question. I assume they have some.
What happens if your seller is a non-resident?
Good correction of your term too. Very political correct. I assume that there's got to be some kind of federal ID number with this. Usually an ITIN, individual tax identification number. If there's an ITIN, then they have to report the sale on that. Or if they have it through an entity, they would report the entity through that, and then the entity has to worry about what they're doing.
Is there any tax-deferred programs for flippers?
No. Flippers are creating a product and selling inventory. So that would be, and I don't mean to be dismissive, but that answer is, I get that question a lot. I have several clients who flip. You're creating inventory. So you've got this product. Let's say it's in accounting school, we always did widgets. And you're creating widgets. So you buy the parts to make a widget, and you create the widget, and you sell the widget, and then you buy more widgets, and you sell more widgets. That's just inventory. And so to a flipper, they're all inventory.
The reason for my question is one of my investors told me that he puts the money back into a self-directed IRA, and he keeps just basically putting it back and forth, doing loans on it. So
retirement accounts are not allowed to have debt. So who's ever lending money to that IRA is doing something wrong, dare I say illegal, because retirement accounts are not allowed to have debt. So if he was going to take the money from his retirement account, buy a property, upgrade it with money from that retirement account, sell it, put the money back into that retirement account, then take 100% of the cost of a new property into that property, that's okay, and it's deferring it because it's just an investment in your self-directed IRA. But you cannot have debt in a retirement account.
So he could pull the money out to invest it, put it back in, but he just can't have debt on it?
It's self-directed. If it's self-directed, so if he's got enough money in that to buy and renovate the property without borrowing, then he can do that. And then when the sale comes, it just goes back to the entity that owns the money or owns the property, which is the IRA, and then he takes those proceeds and invests again, yeah.
Stu, if it is self-directed, you have to be very careful because under self-directed IRAs, you're not allowed to do the work. You can contract the work out, but you can't do it yourself. So there's lots of different nuances that you have to go talk to a qualified custodian who specializes in self-directed IRAs, and they can clarify that.
And whenever you're investing with your self-directed IRA, you also have to watch that the people with whom you're investing understand that it's a self-directed IRA. I have at least a dozen horror stories where self-directed IRAs were invested into a partnership, and the distributions all went to the individuals, but the K-1 all went to the IRA. Tremendously wrong. They all come to you, 20 years after the fact, so you're tough. I am not a fan of self-directed IRAs, as an aside. So.
Let's go back to the non-resident.
Okay.
Okay. Did you know that many of them don't have ITIN numbers? And in other words, you have to have a tax ID number. See, as far as the government's concerned, you're not a name. You're a number. You report the number, your tax return. It's usually a Social Security number, or if you set up an LLC, it's either going to be regarded or disregarded entity. With if it's regarded, it'll have its own tax ID number. So the government sees you as a number. Now let's go back to a non-resident. If they don't have a tax ID number, the first thing they have to do is get one. Number two, they have to get a waiver certificate. To get that, most won't even know until escrow closes, and then the feds are going to create a 15% withholding, plus the state is going to do withholding, even if they're doing a 1031 exchange. So first question you should ask, and it's a very delicate question, because everybody gets bent out of shape these days. Do you have a tax ID number? Next question is, if you don't live here full time, you'll need to talk to a CPA or an attorney to get a waiver certificate. So you'll get out of that 15% withholding. That is a big deal right now because we have so many people who have come from so many countries 10 years ago, 12 years ago, or longer, and are now selling those properties. And there's going to be a federal withholding, and it's all going to hit the fan because they want their money, and they can't have it because the feds are going to take it.
Yes, ma'am.
Okay. My name is Connie Pack with the TRG. I have a question. Let's say my client bought a house as an investment,
okay,
1031 exchange. So after renting out for 2 years, which is the IRS rule, right? And then they move into the house after 2 years, and then they live there for 5 years later, and then they sold it. Now, in that case, can they, the tax consequence-wise, can they pay the capital gain on their personal income tax rate, or the what you call it, the investment, the capital gain rate?
Capital gain is just a capital gain rate. There's only one capital gain. Well, there are 3 capital gain rates, but there is only one. There's one concept. It doesn't matter if it's an investment. It doesn't matter if it's stock, real estate, cars.
Okay, but they still can qualify for $250,000 or $500,000.
They should be able to, for the most part, on that. I know Phil said something earlier, but you got to start with the basis. You start with that basis, and then you have to worry about recapturing the depreciation. But yeah.
Okay, thank you.
Yes, ma'am. Miss North Carolina.
Yeah. I'm a little bit confused. If I sell my house, I bought it for $75,000. I sell it for $1 million. I'm single. I take my $250,000 exemption plus $75,000 plus all my improvements. The balance, do I pay it based on my tax rate, or do I pay it on my capital gains rate?
If it's a long-term capital gain, which means you've held it for more than 1 year, which by definition, if you're getting the $250,000 exemption you have, it's a capital gain.
Has it always been that way?
Yes.
Because I thought it went into your personal income.
Well, it's not, again, it's your personal income, but it's a capital gain that you're paying on your personal income.
Oh, okay.
So it shows up on your 1040, SR or not, and it would show up on the 1040, and it's how you calculate the tax on the 1040.
Oh, so you don't add it to your regular income?
You do add it to your regular income, but it is taxed differently. Taxation of capital gains is not a pretty thing. There's attachments to Schedule D, and there's actually.
Okay. So I do all my income like I normally do,
Mm-hmm.
and then I fill out for the amount I made of my house above $250,000. I fill out on a capital gains form, and I pay capital gains.
Yes, in very layman's terms, yes. You're going to prepare a Schedule D that says that you sold a personal residence. You're going to take that $250,000 exemption as one of your exclusions to the sale, and then you're going to have a capital gain that's going to flow through actually this year to page 1 of the tax return, but the tax is going to be calculated on the Schedule D.
Hi, Gloria Godet with the Real Estate Group. I have clients that have investment properties, say houses and small units, and they have them in different LLCs, but from different states like Nevada and Utah. Does the state of California have a problem with that, or
Where is the property?
the property's in California?
Then they don't care. They just want you to pay tax in California when you sell it.
Oh,
It doesn't matter where your ownership is. I know the discussion was earlier, if I live in North Carolina or Las Vegas and I own a property in California, if I sell it, I pay tax in California.
Hi.
Hi.
I'm Angela with Berkshire Hathaway.
Hi.
My question is, could you, or it's not a question, could you elaborate or explain more about the self-directed IRAs that you were just talking about that you're not a fan of? Could you just like elaborate more on what that means?
I really don't like them.
Yes. Yeah, like why?
I really, really don't like them. Because, so I heard somebody say TurboTax before, which is something that gets under my skin. But, well, you know what? I have no problem with TurboTax. If you've got a W-2 and a house and you don't have anything exciting going on your tax return, TurboTax is a perfectly fine product. People screw it up, but it's harder to. If you have anything else exciting on your return, if you have rental property, if you're self-employed, if you have a lot of capital transactions, I think even though there's the commercial says you can dance, you should be able to do your own tax return, you shouldn't. For the same logic, I don't think you should direct your own IRA. You can tell your investment person where you want to put the money, but invariably, and I don't want to make a blanket statement, but if you're left to manage your own IRA, something's going to happen and you're going to have a really great idea and you're going to invest in it, and it's either going to mess up the IRA completely or you're going to blow the money. Self-directed IRAs became very popular when people wanted to find ways to invest in businesses, and that their fiduciaries weren't interested in investing. So that's when self-directed IRAs became very popular. And this, I think, was in the 70s or 80s. It just really, I don't think they're a good idea. There's got to be, I hate to restrict people, but people need often to be protected from themselves. So that's...
like a realtor?
Like a realtor, yeah.
My question is about the declaration of your residence, principal residency. Nowadays, a lot of people move to Henderson, Las Vegas, to have a second house.
Yep.
So they use that as a vacation house. But at one time, some people want to claim Nevada as their principal residence to avoid the California tax.
That happens?
Yeah. And I read from the newspapers the judge decided this person's principal residence is in Nevada because his dog lived there. So how, as a CPA, how do you determine where is your principal residence?
So there was a case several years ago. A guy invented something in California. Now, normally, the state of California takes about 2 years to investigate these things. This case went on for about 10 or 12 years. This guy invented something in California, sold a unit. I wish I could remember the details. Sold a unit, made a lot of money, reported it in California, then moved to Nevada. And California was after him after that because apparently he was making a lot of money. They checked where his doctor was. They checked where his vet was. They checked where he got his haircut. They checked where he grocery shopped. They went through his trash and looked at his receipts to see where things were. And ultimately they lost, but they were really anxious to get this. So the answer is, and I do have a couple of clients who are Nevada residents who I seem to see in California every time I turn around. But they have nothing tying them here specifically. They don't have I don't know where they go to the doctor. I don't ask that question. I don't ask where they're registered to vote. I don't ask where their library card is. If your car is registered in Nevada, you're probably a Nevada resident. If your car is registered in California, you're probably a California resident. voting registration is probably important too. Not a lot of people use library cards anymore. But if you're going to roll that dice, you got to be willing to, you got to know that you're going to lose sometimes. And so wherever your dog goes to the vet, and my dog goes to the vet on Hawthorne Boulevard, the VCA Claremont vet, they're really good. I got 2 dogs, and they're really good dogs. This thing is killing me.
I got a question for you. So is it better to be a 1099 independent contractor, or is it better to file as an S Corp or an LLC?
Oh, that is such a good question. Thank you. If you're the sole owner, being an LLC is the same thing as filing as a sole proprietor because it's a disregarded entity. So if you have a partner, you can be an LLC. But if you're a sole proprietor, and you are better off being a corporation than being an LLC. And corporations, and you probably should be an S corporation, but there's a lot of work with that too, because corporations need to pay salaries. And so every year you need to pay a salary. I have a client who is a doctor. She makes a lot of money. She pays herself a salary once a year. She writes a we sit down, we figure out what her taxes are going to be sometime in mid-December. And I tell her, you're going to owe $150,000 in taxes, so we're going to give you a W-2 for $200,000. You're going to pay your taxes, pay your retirement plan, and you're going to have a net paycheck of 0. And she says, thank you very much, makes her tax deposit, and she's fine. She's an S corporation. She's a doctor. She's not going to get audited. They don't often get audited unless they've had a lot of conventions in the Bahamas. But so if for you guys, if you decided that you didn't want to be a Schedule C anymore, I would recommend an S corporation over an LLC, screaming and yelling. Wait, she's going to bring you the mic. Wait.
Continue to your answer. Can you change your compensation just like the salary every year? Like, for example, you estimate that you're going to make $200,000 next year, or you reported $200,000, but the year before you reported $100,000.
So that's the beauty of a corporation, because the board of directors meets and determines how much the compensation of the officer is going to be. And so when you have your board of directors meeting, which could be in the Bahamas, when you have your board of directors meeting, they say officers' compensation this year is going to be $200,000. Last year it was $100,000, and next year it might be $20,000. I wouldn't make it $20,000, but that's so yes, you can change that from year to year.
One person corporation can have a meeting?
Well, yes. Well, so you should always have, there's always a board of directors. So what happens is the sole owner elects the board of directors. Coincidentally, my corporation has elected my wife and I as the directors. And if we wanted to, because I have to tell you, I've been doing this for a really long time, we have never gone to dinner and not discussed business. But we don't write off all of our dinners as corporate meetings. But that is something, so yes, you find somebody else, you have a director, you have a conversation, and hopefully your director agrees with you and does not create a stockholder issue.
Just a question with regards to all those dinners. Do you save your receipts, or can you just show your credit card statement that it was paid for?
If you're going to show just your credit card statement, on your credit card statement, you better have written with whom you had dinner and why.
Oh. Okay, thanks.
And back of the receipt's fine. Back in the old days when people used to have paper calendars and they used to write on them, it was easier. But now I find that if I go to look at my calendar for last year, all that information is gone. And so at my office, as an aside, I keep a paper calendar as well as my Outlook.
Under the escort status, can you write off the entertainment?
No, entertainment is not deductible by any entity. No. Although if you want to take me to a ball game and the Yankees are playing, I don't know if anybody noticed, I do have my Yankee socks on. If the Yankees are playing and I'm your accountant, I might look the other way. Yes?
As far as entity type, what about the option of choosing to be an LLC with election of S Corp taxes?
Why? It's the same thing. It's just you're creating another layer that's going to be difficult for you to work with.
Isn't there
We've had people, there is a rule that you can do that.
Isn't there a little less requirements for the LLC portion rather than...
Which way? On the tax return?
No, on the legal portion.
Legal portion, LLC should still have meetings. I have not had an LLC audited. Could somebody knock wood for me? I have not had an LLC audited, but I would think that if an auditor came in and was auditing an LLC, they would ask for minutes as well.
Hi, I'm Susan. I wanted to ask about not entertainment, but what about lodging? I did quite a few deals out of the area, and I...
Absolutely. Business travel is tremendously deductible. Your trip there, your lodging there, your meals there, 50%, and pretty much most things you do there, except unless it's entertainment. And if you had to take a spouse with you, your plane ticket is deductible. Your spouse's plane ticket is not deductible. But I presume you stayed at one hotel room, so the hotel room is still deductible. So you're only losing the deduction for the spouse's airline and meals.
Hi, I'm Claire. I have a short question.
This thing, I don't know if you've ever been up here, but this thing is blinding. Yes.
I have a short question for short capital gain, less than a year. It's treated as income.
Ordinary income.
One of the income. Okay.
Ordinary income, just like a W-2, just like interest, dividends, except they're not subject to, ordinary income.
Oh, hi, this is Gretel. And so for S Corp, you can own by one person, right? So
No, S Corp can have as many stockholders as you want.
Okay, but one will be fine as well.
One is fine.
Okay, so if so, can they deduct the home offices?
So home office, that's another thing. That's a very good. Many of my clients who are S corporations work out of their home. And so the corporation pays them rent. And so now they have a Schedule E with a rental property that deducts the appropriate portion of their mortgage, property tax, utilities, insurance, gardeners, whatever the other costs are. If it's 10% of your house, you get to deduct 10% of that against the rental. And the rental income is usually determined by what those expenses are. And because it's still going to come through to you as income, either through the K-1 on the S Corp or the Schedule E.
Yeah, you keep talking about entertainment. If you take someone to dinner as a real estate agent, can you write the dinner off?
That's a meal. That's not entertaining. I don't know what it's like to eat with you, but when people don't find eating with me entertaining. Entertainment is ball game, theater tickets, concerts. That's kind of like theater tickets. Anything else?
Any other questions?
No, but they need you on the mic. Oh. I can talk louder than you. This thing is a pain in the neck. If I got to do it, you got to do it.
No problem. Again, this is Francesco. Let's assume I have some properties in Hawaii, and let's say I take my wife and my daughter is part of my staff. Can I deduct her ticket?
When you say part of your staff...
She does contracts for me.
And do you pay her?
Of course.
If you pay her, then you're just transporting an employee. What about your wife? Do you pay her?
Well, she takes half of it anyway.
That's not the same. I like that. Just as an aside.
Okay.
And now my wife happens to work in my business. She does a good deal of work. But even if she didn't, she would get a W-2.
Very good. So
because she is an employee.
Excellent. So my daughter that works for me as an employee, I can deduct her airplane ticket. That's my point.
Because you're taking staff with you.
Correct.
You may need at some point to justify why you needed 3 people to go and collect a rent check. But outside of that...
No, I don't collect the rent check. The money goes directly into the bank. However, When we go there, she has to be familiar with the property, so when clients come and they have a question, she's able to answer it. But unless she's there, she lives and breathes and eats over there, she doesn't know the property, then she won't be able to answer it.
Then, should you get audited, I suggest that you sit in on that part when they're asking you that question.
Okay, for $500, it's not worth it.
The guy who said foreigner before.
To be fair, that question was not my question. Not to throw anyone under the bus.
Oh, well.
My question is, so I have a LLC registered in the state of Washington where I receive 1099s for that LLC. I'm W-2 and residing in California. Do I have to pay California state income tax from that 1099 in Washington?
Are you a California resident?
Yes.
Yes.
Oh.
So there's special things about being an American citizen or American resident and being a California resident. As an American citizen, you're taxed on your worldwide income. So if I have a rental property in France, I get to pay tax on that in the U.S. Now, if I've been taxed in France, I get a foreign tax credit. But if I haven't been, I just pay tax here. Being a California resident, you also get to pay tax on your worldwide income. But again, there is no foreign tax credit in California. There's another state tax credit, but you and I both know you don't pay tax in Washington. Yeah. Okay.
Can I ask one more question?
Sure.
So the entertainment not being a tax credit.
Deduction. Credits are different than deductions. It's always important that you have that distinction in your mind.
A deduction?
Yes.
So what if a baseball game you use as a client gift?
Gifts are limited to $25 per person. So if you can find tickets to a ball game for $25, I will go to, where's that place? All the way out eastern. Never mind. Lake Elsinore. I bet you could buy a ticket to the Lake Elsinore Storm for $25.
I think you could get the Chargers tickets for like $25.
Yeah, but that's on the secondary market.
Any other questions back here?
When children take over properties with step-up values, does it mean that the assessor's office go on and reassess the property with new property tax value base?
If they've inherited property from a parent, typically no, as I understand it. Don't you carry that basis over from the previous?
They have to go back to the tax assessor and fill a form out.
But the assessor they get the same tax basis, yes. Same tax basis, just at higher income tax basis. So you pay the same property tax your parents were paying, but you have more depreciation. And I'm going to tell you as we finish, I was running really late when I came here today, and as I was pulling up, I said, let me take out my business cards, which are sitting on my desk. So I think a bunch of people know here how to reach me. If you don't, let me know, and I will tell you how to reach me.
One final question. Make it a good one.
No, that's pressure. Watch out, he'll throw you under the bus if it's not a good question.
No, I got to be careful. Do you have any insights on any upcoming tax law changes?
That was a good one.
Please.
They want to know if there's any insight on upcoming tax changes. There are some ballot measures, but I can't comment on a ballot measure, and I really can't comment on anything that's not law because I don't know. I hear a lot of things, but none of it is done until it's a law. So, yeah.
Can you do a quick refresher on the tax reform? I don't know what it's called, but it's up until like $150,000. They could take 20% off. I think it was in 2018.
Oh, the 199A deduction?
Yeah, in case people aren't familiar with it.
So 199A says that if you have a business that is not a specific kind of business, and that list is very large, but if you have a business, realtors qualify, you can reduce your income by you can reduce your taxable income by 20% of the income of that business. So let's say, and rental properties are also one of those businesses, let's say you have a W-2 for $100,000 and you have a Schedule C income of $20,000. I got to make the math not hard. and you have a rental property that made $20,000, because I'm just trying to make the math easy. So now you've got that $40,000 that's eligible for the 20% reduction. So when you look at your income, you're going to pay on your self-employment tax, you're going to pay self-employment tax on the 20, but we're going to add the 100 from the W-2, the 20 from the rental, and the 20 from your Schedule C. That comes to 140. Then we're going to reduce it by effectively 20% of the 40, so 8,000, and then you pay tax on that. I say effectively because it's not really. If you've made a pension contribution, it reduces that 40,000. If you've made you have to pay self-employment tax, so half of the self-employment tax reduces that number as well. So it is 20%-ish. And if you're in a designated industry, like accountants, doctors, lawyers, pretty much actors, all of these people are not subject to that 20% rule. So it's really a good, oddly enough, architects and engineers are not subject to that limitation. They have a good lobby.
All right, I think that's going to wrap it up. Stu, thank you so much. You truly are